Turning 65 unlocks your KiwiSaver. Most Kiwis get this wrong. If you don't understand exactly how this works, you could end up paying more tax than you need to, or accidentally reducing the amount you take home from NZ Super at the same time. Thousands of dollars can quietly slip through the cracks simply because nobody explained the rules properly. There's a specific mistake retirees make in the first few weeks after they access their KiwiSaver that catches almost everyone off guard, and I'll walk you through exactly what it is and how to avoid it. This affects every KiwiSaver member turning 65 from 2026 onwards, and the tax rules involved are more generous than most people realize, but only if you handle them correctly. I'm David, and you're watching New Zealand Pension Plan, the channel where we break down NZ Super, government support programs, and important updates that could affect your finances so you can make informed decisions and make sure you're receiving every entitlement you may qualify for. Today we're covering KiwiSaver Retirement Withdrawal, when you can access it, how much tax you'll actually pay, what happens if you try to move that money somewhere else, and the difference between KiwiSaver and NZ Super because a lot of people mix these two up, and that mix-up costs them money. Let's start with the basics because getting this part wrong sets up every other mistake down the line. KiwiSaver and NZ Super are two completely separate systems. NZ Super is a government pension. It's paid to you fortnightly by work and income, funded through general taxation, and you qualify for it once you turn 65 and meet the residency requirements. It doesn't matter how much you've saved, how much you own, or what other income you have coming in. NZ Super is not means tested. You get it regardless. KiwiSaver, on the other hand, is your own money. It's been sitting with a provider, invested in the market, growing or shrinking depending on how that fund performs. It's not a government payment. It's your personal savings account with tax advantages built in. Here's why that distinction matters so much. Drawing down your KiwiSaver does not reduce your NZ Super, and receiving NZ Super doesn't stop you from accessing your KiwiSaver. You get both. They run side by side. I mention this up front because there's a persistent rumor going around that withdrawing your KiwiSaver somehow lowers your NZ Super payment. That is false, and I'll come back to exactly why later in this video, along with a few other myths that catch people out. Now let's talk about when you can actually get your hands on your KiwiSaver. For most people, the age is simple. 65. That's the KiwiSaver eligibility age, and it lines up with the NZ Super qualifying age. Once you turn 65, your full KiwiSaver balance becomes available. Every dollar you put in, every dollar your employer put in, every government contribution you ever received, and all the investment growth on top, it's all yours to access. But here's the detail that catches a good number of people out, especially those who joined KiwiSaver later in life. If you join the scheme after you turn 60, there's a 5-year membership rule that kicks in. You need to have been a member for 5 years before you can withdraw, even if that pushes you past 65. Let me give you a practical example. Say you joined KiwiSaver at 63. 5 years from that point takes you to 68. Even though you're already past the normal NZ Super age at 65, you won't be able to access that KiwiSaver balance until you turn 68. If you joined before 60, none of this applies to you. Your access date is simply your 65th birthday. This is worth checking now, not later, especially if you're in your late 50s or early 60s and haven't joined KiwiSaver yet, or you joined recently. It could be the difference between accessing your savings right when you retire or having to wait several extra years while relying solely on NZ Super in the meantime. In just a moment, I'll explain exactly what your withdrawal options look like once you do become eligible. And there's an important detail about deadlines that a lot of people get completely wrong. So once you hit your eligibility date, what actually happens? Nothing happens automatically. That's the first thing to understand. Your KiwiSaver provider doesn't just pay your balance out to you the moment you turn 65. You have to actually apply. Nobody does this for you. Once you do apply, you've got real flexibility in how you take the money. You can withdraw the full balance as one lump sum. You can take out a portion and leave the rest invested. You can set up regular withdrawals weekly, fortnightly, or monthly, essentially turning your KiwiSaver into a second income stream alongside NZ Super. Or you can simply leave the whole thing invested and untouched, letting it keep growing. And here's something that surprises a lot of viewers. There is no deadline. There is no cutoff date. There is no rule anywhere that says you must withdraw your KiwiSaver by a certain age or you lose it. You can leave your balance sitting in your KiwiSaver account for years after you turn 65, still invested, still growing, and access it whenever you actually need it. Many New Zealanders are now spending 20 to 30 years in retirement. That means your KiwiSaver may need to last you for decades, not just the first few years after you stop working. Because of that, a lot of financial advisors suggest a blended approach. Take out what you need now and leave the rest invested to keep working for you, drawing it down gradually over time rather than emptying the account the moment you're eligible. You can also keep contributing to KiwiSaver after 65 if you're still working or want to keep saving. The one thing that stops is the government contribution. Once you turn 65, you're no longer eligible for that top-up from the government, regardless of how much you personally put in. Your employer might keep contributing too, depending on your individual employment agreement, so it's worth checking your contract rather than assuming either way. Now let's get into the part most people are actually here for. The tax. This is where I want you to pay close attention, because the tax treatment of KiwiSaver withdrawals is more favorable than most people expect, and understanding it properly can save you from making an expensive mistake later. When you withdraw your KiwiSaver at 65, that withdrawal itself is completely tax-free. You do not pay tax on the lump sum when it lands in your bank account. Full stop. Why? Because your KiwiSaver fund has already been paying tax on your behalf every single year as your investment earns income. This happens through something called PIE tax, using a rate called your prescribed investor rate, or PIR for short. Your fund manager calculates and pays this tax annually on the growth your account generates, based on the rate you've told them applies to you. So, by the time you actually withdraw the money, the tax has already been dealt with along the way. There's no second tax bill waiting for you at the exit. Your PIR sits at one of three rates: 10.5%, 17.5%, or 28%. Which one applies to you depends on your taxable income over the last 2 tax years, and importantly, it's based on the lower of those 2 years, not the higher. If you don't tell your provider your correct rate or you've never checked it, the default rate applied is 28%, the highest of the three. That means a lot of retirees who should be on a lower rate are sitting on 28% right now simply because they've never reviewed it. Here's a practical example. Let's say you're on the 28% PIR, but your actual income level over the past 2 years would actually put you at 17.5%. Every year that goes by with the wrong rate on file, you're overpaying tax on your KiwiSaver earnings. That's money you could be keeping simply by contacting your provider and confirming the correct rate. It takes minutes to fix, but most people never think to check it. Stay with me because there's a critical mistake coming up that could cost you far more than a wrong PIR setting, and it happens right after people withdraw their lump sum. Here's the catch. And this is the single biggest financial trap in this entire topic, so listen carefully. The withdrawal itself is tax-free. But what you do with that money after it lands in your bank account is a completely different story. If you take a large lump sum out of KiwiSaver and simply drop it into a regular bank savings account or a standard term deposit, any interest that account earns from that point onward is taxed at your normal marginal income tax rate, not at your KiwiSaver PIR. And your marginal rate can be significantly higher than the 28% cap that applies inside KiwiSaver. If you're on a higher income bracket, that gap can be substantial. There's a second layer to this catch that trips people up even more, and it directly affects your NZ Super. If the interest or income generated by that lump sum pushes your total income up, it can change your NZ Super tax code. Say you were previously on the standard M tax code, and now, with extra income coming in from your savings, you shift onto an S or SH code. Your gross NZ Super entitlement doesn't change, but the after-tax amount that actually lands in your account each fortnight goes down. You could end up taking home noticeably less from your NZ Super payment purely because of a decision you made about where to park your KiwiSaver withdrawal. Let's put real numbers on this so it's crystal clear. As of April 2026, a single person living alone on the standard M tax code receives $1,110.30 after tax every fortnight from NZ Super. If extra income shifts that person onto an S tax code instead, that fortnightly payment drops to $1,068.30. That's over $40 a fortnight lost, simply from a tax code change, not from any reduction in your actual entitlement. Large lump sums sitting in accounts generating income can also indirectly affect other income and asset-tested support you might be receiving, like the accommodation supplement. It's not that KiwiSaver withdrawals are directly assessed. It's that the income those withdrawn funds generate afterwards can be counted. So, what should you actually do instead? This isn't financial advice, and for larger balances, I'd genuinely encourage you to speak with a financial advisor who can look at your specific circumstances. But broadly, many retirees choose to leave a portion of their KiwiSaver invested rather than withdrawing the full amount at once, precisely because it continues to benefit from that lower capped PIR tax treatment while it stays inside the KiwiSaver structure. Others withdraw only what they need for immediate expenses and leave the rest to keep compounding. Take a moment to consider whether this applies to your situation. If you're approaching 65 and planning to take a large lump sum, it's worth thinking through where that money is actually going to sit afterwards, because that decision matters just as much as the withdrawal itself. Now, in a moment, I'm going to walk through some of the most common myths I hear about KiwiSaver and retirement, because getting these wrong could genuinely cost you money or cause you to make a decision you didn't need to make. Let's start busting some myths because there's a lot of misinformation floating around on social media about this topic, and separating fact from rumor is exactly why this channel exists. Myth number 1. You must withdraw all your KiwiSaver by age 65, or you lose it. This is false. Completely false. There is no deadline. There is no expiry date on your KiwiSaver account. You can leave your balance invested for as long as you like after turning 65, take partial withdrawals whenever suits you, or leave it entirely untouched. Nobody is going to take that money away from you for waiting. Myth number 2. Withdrawing your KiwiSaver reduces your NZ super payments. Also false. As I explained earlier, these are two entirely separate systems. NZ Super is not means tested, and your KiwiSaver balance, or what you choose to withdraw from it, has no bearing on your NZ Super eligibility or your gross entitlement. The only thing that can shift is your tax code. If the income generated from withdrawn funds pushes you into a different bracket, and that's a different mechanism entirely from KiwiSaver directly affecting NZ Super. Myth number 3. KiwiSaver withdrawals get taxed when you take the money out. False. As we covered, the tax is paid annually inside the fund through PIE tax at your PIR, as the investment earns income. By the time you withdraw, that tax obligation has already been settled. The withdrawal itself doesn't trigger a new tax bill. Myth number 4. You need to have joined KiwiSaver a set number of years before you turn 65 to access it. This one is only partially true, and it's worth clarifying properly. If you joined KiwiSaver before you turned 60, your access date is simply your 65th birthday. No extra waiting period involved. But if you joined after turning 60, that 5-year membership rule I mentioned earlier applies, and your access date becomes 5 years from your join date, even if that's later than 65. Myth number 5, and this one comes up a lot. You can transfer your KiwiSaver directly into your NZ Super payments, essentially merging the two. This is false. There is no such mechanism in New Zealand. Your KiwiSaver withdrawal goes to your personal bank account. It doesn't get folded into your NZ Super payment in any way. The one genuine cross-border option that does exist is for people permanently emigrating to Australia who can transfer their KiwiSaver balance into an eligible Australian complying superannuation scheme. But that's a specific overseas transfer pathway, not a domestic merging of the two New Zealand systems, and it doesn't apply if you're staying in New Zealand. Keep watching because there's one more area worth covering, particularly if you're still a number of years away from turning 65, because some of the settings around KiwiSaver contributions are shifting, and it's worth knowing about now rather than finding out later. If you're not yet 65 and still contributing to KiwiSaver, there are a couple of changes worth being aware of. The government contribution, sometimes called the member tax credit, has already been halved. It used to be 50 cents for every dollar you contributed, up to a cap of $521.43 a year. As of July last year, that dropped to 25 cents per dollar, capped at $260.72. To get the maximum available, you need to personally contribute at least $1,042.86 between the 1st of July and the 30th of June each year. This only applies if you're between 16 and 65 and earning under $180,000. On top of that, the default minimum contribution rate for both employees and employers is stepping up. It moves from 3% to 3.5% from the 1st of April to 2026, and then up again to 4% from April 2028. If your budget is tight, there is an option to apply to inland revenue to temporarily drop back to 3% for up to 12 months. So it's worth knowing that flexibility exists if you need it. None of this affects your withdrawal rights once you turn 65. But if you're in your late 50s or early 60s, understanding how these contribution changes affect your balance between now and retirement is worth factoring into your planning. There's also a piece of proposed legislation worth flagging, purely so you're not caught off guard by headlines. The government has announced its intention to introduce a KiwiSaver amendment bill that would create new early withdrawal pathways for people buying a first home on a farm through a commercial entity, or for those in service tenancies where their employer is also their landlord. I want to be very clear about this. These changes are not yet in force. They still need to pass through Parliament, and even once passed, they wouldn't take effect until at least 6 months after they receive royal assent. If you see headlines about this, treat it as proposed policy, not confirmed law, until Work and Income or Inland Revenue formally confirm it's in effect. So let's bring this all together because we've covered a lot of ground. KiwiSaver and NZ Super are separate systems, and one doesn't reduce the other. You can generally access your full KiwiSaver balance at 65, unless you joined after turning 60, in which case the 5-year membership rule may push that date later. There's no deadline to withdraw. You can take it all. Take some, set up regular payments, or leave it fully invested for as long as you like. The withdrawal itself is tax-free because your fund has already paid PIE tax annually at your prescribed investor rate. But where you put that money afterwards matters enormously because standard bank interest is taxed at your marginal rate, not your KiwiSaver rate, and a jump in income can quietly shift your NZ Super tax code and reduce what actually lands in your account each fortnight. Make sure you're not missing out on support you may be entitled to, and make sure your PIR is correctly set with your provider, because getting that wrong, even by accident, can cost you money every single year you leave it unchecked. You may want to check your eligibility and your provider settings after hearing this, particularly if you're within a few years of 65, or if you've recently made a large withdrawal and haven't thought carefully about where that money is now sitting. If you found this update helpful, make sure you subscribe to New Zealand Pension Plan. I'm David, and my goal is to help you stay informed about NZ Super, WINZ, MSD, and every important government support update that could affect your finances. Thank you for watching, take care, and I'll see you in the next update.